Hey, this is Greg. Welcome to the channel. As you can see, we just had we're in the process of having another snowstorm. Another day, another snowstorm in the Northeast. Yes, every other day it snows here. But that's not why I'm making this video. I'm making this video because if you've either been watching the channel or even if you're new to the channel, I have been talking about for months, going back to early January, the rise that we're seeing in the bond market yields, particularly on the long end of the curve. The 10-year has gone from the end of December to now, which is the middle of February. Basically, it's gone up 40 basis points on the long end, the 10-year Treasury. And I have stated a number of times that it's my belief that this is signaling a rise, potential rise in inflation in the near future. And I believe it's resulting from the massive fiscal stimulus that the government has been pumping in and is planning on pumping in to the economy, currently considering a $1.9 trillion stimulus package, much of which is going to people that don't need it. Some people do need it, obviously, which is good. And then a big chunk of it is going to bail out these blue states that were shut down from the pandemic. And a bunch of, it's coming out, all these earmarks. Remember earmarks? Earmarks are these special pet projects that they tack on to bills, that Congress people tack on to bills to benefit their constituencies, which have absolutely nothing to do with the purpose of the bill. Okay, and we're seeing that. We're seeing all the pet projects being tacked on that have nothing to do with the pandemic and all this kind of crazy stuff. So all that's going on. There's a plow. All that's going on. And this is happening in a time period where you're going to see unprecedented pent-up demand in the economy that will be due to, or is due to, the vaccines coming in. And those two things combined, I think, are going to cause a demand and supply gap. And that is going to put pressure on prices, and that will cause the inflation. I ran across a very interesting interview with Mohamed El-Erian on CNBC this morning, which I want you to listen to, and then I'll come back and make some further comments. Okay? Here it is.
Can we start with the 10-year? Because since last time we spoke, it's ticked up some more, and we know that, what is it? The boiling water with the frog. You know, you started out just barely warm, and it doesn't even notice. Is that what we're seeing here? And sooner or later, we're going to be in like boiling water?
So, Joe, it turns out, according to Adam Grant, that story is wrong. But what we're seeing is something very simple. The market mood has changed. It's no longer whether yields are going higher, but when is a move too big? That is what the market's trying to figure out. And that has three elements. It's about the economy, it's about market conditioning, and it's about the Fed. So far, people think that this move is, well, not welcomed, is fine, but keep an eye on it, because the faster we move, the more you're going to destabilize all three of these elements. That's why I've had it as a risk factor that I've talked to you about for the last 2 months.
The reasons for it, and it's a combination, I guess, and it's all related. I mean, we could be reopening, and earlier, a guy like Dr. Scott Gottlieb said it's going to be like Woodstock, which I immediately thought, wow. I mean, I remember that was crazy. I mean, if we reopen, or Roaring '20s, whatever you want to talk about, but there is some pent-up urge to go let everybody let their hair down. You can just feel it, Mohammed. So that might be coming. But we also got some hot inflation numbers, and a resurgent economy and a resurgent consumer might be inflationary. So they're related. But is that what the 10-year is sniffing out?
Yeah, it's the second one that we should worry about. You know, there's good reasons for yields to go up, the first one. economic activity, and there's bad reasons, inflation. And what we're seeing, interestingly, is that economists, even those who have long supported a big fiscal push, are saying be careful. Going big may be too big. You had Olivier Blanchard over the weekend who joined Larry Summers and saying, look, I've always supported fiscal injections, but this may be too much. This may result in an output gap. The multipliers are too high. And guess what? You'll get inflation. He didn't even mention financial stability risk. So it is the second element that you may destabilize inflationary expectation that the markets are really worried about.
So see along with me, Mohammed has been singing off the same song sheet, so to speak. He's concerned about the supply gap between the pent-up demand, which will inevitably occur once the vaccine kicks in and people start traveling and going back to their normal lives. Demand is going to naturally pick up. And at the same time, you're going to have all this fiscal stimulus coming in. Now, he referenced Larry Summers. Now, I can honestly tell you I've never agreed with Larry Summers on anything, but he has come out, pretty aggressively recently and said, look, normally I'm really into, this fiscal stimulus to jumpstart the economy, but in this particular case with the 1.9 trillion, Larry Summers was saying that last week that he thinks that this is overdone and much of it is not needed. So in that particular case, in the rare case, I actually agree with Larry Summers on this point. Okay, so keep an eye on this. It's already gradually eroding some of the higher momentum stocks, some of the mega cap tech stocks. You can see them selling off today. This is just the beginning. It's just the tip of the iceberg. This is going to be a recurring theme that's going to go through the markets for the foreseeable future. Keep an eye on it, and we'll be following it, and we'll be giving you more information on this channel as time goes on. So please, if you found this valuable, like it, and please subscribe so you can be on board for future presentations, which will be coming your way very soon.